Jason Barton, thank you very much. We will start, first of all, with Jason. He's going to make the case because this is a stock that is obviously on people's shopping lists if it goes down in value. Why does it belong there, and how high could it go, Jason?
Sure. So this is a business of today that the market's basically valuing the retail business at zero or less than zero. So when you take a look at the AWS business, I think it's ironic, but you basically have two internet/media analysts, talking about this company when effectively 100% of the value today, or most of it, is actually the cloud business. So if you put 25 times next year's AWS profit, like EBIT, including depreciation, and then you put 10 times on advertising this year, 8 times next year, EBITDA, assuming a 65% margin, you're basically paying, nothing for the retail business, nothing for Prime, nothing for pay by Prime. So really, that is the opportunity. So unless you are a bear on AWS long term, you have to buy the stock.
All right, so $175 implies like a 50-some% upside surprise there for the stock if it does come to fruition. Barton, you've been on the right side maybe of this, arguably speaking. You've been a little bit more negative on the stock here, and the price action has kind of validated that view. Why does it keep going lower?
Okay, so look, I don't have the same sum of the parts that Jason has. I think that the multiples for cloud services companies are not what they were. I think if you do a multiple that's more in keeping with where the peers are trading, you don't get all of the value in AWS, and you do need retail to work. And I think that the issue with retail is that this is the company's legacy. It's Amazon's core, and it's not a growth story. It's a day two story, which I know Bezos has argued that that's death, but I think it's not. I think that's an overstatement. I think it's normal maturity. And for, some number of quarters, these guys have not been outperforming retail at large. And I think that there's a lot of reasons for that. One of them is that they've killed the weak links, and the competitors are stronger, and they're better in e-commerce, and they're better in click and brick combinations than Amazon is right now. And I think the consumer's rotating away from where Amazon is in retail towards services, away from things. If you have these guys growing like they have been for some period of time, the consensus revenue estimates are too high and they're coming down. And I think that's difficult to make an outperform argument for a high multiple stock like this, when the revenues are at risk versus the sell side consensus.
Barton, if I could follow up on that, I get the reasons why you feel a little bit less optimistic about this. Let's take this and say from an operational standpoint, you take a look at the numbers, you scrutinize them on a daily basis. What needs to change? What would be those tea leaves that you start to say, hey, maybe this is trending in the right direction? What would get me to be more constructive on the stock? What would you need to see first and foremost to make you feel better about Amazon's story going forward?
Well, I think, one thing that would help is if you were buying the stock at a lower multiple, which means the stock could be cheaper than it is here. I have a neutral rating on the equity. So I do think there's a real business here that could be attractive. I think that expectations are too high. The fact that I'm the bear on a bull-bear debate speaks to the fact that everyone else on the street has a buy on it. So I think that there needs to be a reset in expectations. There needs to be a realization that, the numbers need to be adjusted. And I think that would help a lot. I think retail, it's a great story historically, but I think there needs to be an acceptance of, think trees don't grow to the sun. There is a point where things start to normalize. And I think the numbers argue that we're approaching that, heading into a recession with competitors stronger in online, and that needs to be in the consensus.